we're going to go ahead and get started. Welcome, everyone. I'm Emily Cabbage, NAIFA's Director of Marketing. Today, we have Harlan Akola and Barry Sachs discussing tax planning with home equity. A few housekeeping items. All attendees are on listen-only mode. If you have a question, please use the Q&A feature at the bottom of the screen. We'll address questions as time permits at the end of the session. It's now my pleasure to turn things over to the National Reverse Mortgage Director at Fairway Independent Mortgage, Harlan Akola, and also Barry Sachs, our retirement income portfolio expert. Gentlemen.
Thank you very much, Emily. Always appreciate all the behind the scenes work that you do. All we have to do is show up and talk. That's the easy part. I'm incredibly fortunate today to be having Dr. Barry Sachs with us. And, Dr. Sachs is a humble guy, but I want to make very clear that the wisdom that you're going to get is pretty darned important. I challenge any of you. I've asked hundreds of people this question. And that is, how many people do you know who have a PhD in semiconductor physics from MIT, a professor at UC Berkeley, and also has a law degree from Harvard? My guess is you don't know anyone. Nobody has ever said, yeah, I know somebody like that. Well, we are fortunate enough to know Dr. Barry Sachs, and he is willing to share his incredible experience that he spent over 35 years as an ERISA attorney dealing with qualified retirement plans. He is the expert on taxes in retirement, and he started everything that we're working on. He's really responsible for NAIFA and Fairway working together in a long history, because back in February of 2012, his research was published in the Journal of Financial Planning. And him and his brother shared their overall analysis and research that they had done that showed that a reverse mortgage was not a loan of last resort, and that it should be considered in an overall plan, not as a last resort, but as something that would just fit into any retirement income plan. So it's absolutely my privilege to have been able to know him personally, talk with him personally. He's been to our offices in Marshfield and many of our training sessions, even stopped out at my house one time when he was in the little city of Marshfield, Wisconsin. Yet he has spent an incredible amount of time, and today he lives in San Francisco. And this is going to be a bit of a strange way to open up this session today, but I think it's important because Dr. Sachs does not, quote unquote, need a reverse mortgage. He's obviously a very successful person in a great retirement, yet he has two homes, one in San Francisco and Sonoma, with using the reverse mortgage tool to help him. I think it's kind of important when you listen to anyone talk about any product. Do they use it themselves? Do they believe in it? Dr. Sachs, if we could start out, you gave me permission, so I'm going into your personal information. Tell us about how you ended up retiring with having two homes in some of the most expensive areas in the entire country, if not the world.
Well, okay, I'm happy to relay my little story. I always begin this story by recalling an ad that probably nobody is old enough to remember. There once was a car called a Packard, and the advertisement for a Packard was always, ask the man who owns one. And of course, in those days, I guess more cars were owned by men than by women. But in any event, yes, I do have a reverse mortgage, and yes, it has made a huge difference in my own living. I started right out of law school with a negative net worth, and went to work in a fine law firm which specialized in tax matters, which is what I wanted to do. And the marvelous thing was the managing partner, who was my mentor, was in on Mondays and he was in on Tuesdays, but he wasn't in on Wednesday. He was in on Thursday and Friday. So he had two-day weeks each week. And I'm wondering, how do you do that? What are you doing? And it turned out he had a house in Napa that he went to. So he lived in San Francisco on Clay Street, where I happen to live. And he went to his country house in Napa for the weekend and for Wednesdays, which is roughly an hour away from San Francisco. I said, someday I'm going to do that too. There I was, right out of law school with nothing, owning nothing, and a net worth, and I owed a bunch of student debt. So my net worth was negative. Anyway, over the years, it finally moved up to zero, and then it became positive. And that picture was still in my mind. So ultimately, I actually did get this. I actually oversaw the building of it and the design of this house in Sonoma, which I deeply love. It's been there for 26 years now. The point being, though, that I got the San Francisco house, which is, of course, walking distance of the office. And that's where I lived all the time I was working in law firms in San Francisco. But the idea of retiring to Sonoma was terrific, but it took a while to even gather together a down payment. Anyway, I timed it such that the house in San Francisco was literally paid off in the very same year that I retired. But the house in Sonoma was not. There was still a mortgage big enough on it so that there would be no way that in retirement with the 401k that I had put together for myself and all my partners could possibly both pay the mortgage and keep me alive. Pay for lunch, for example. Anyway, as a result, what I thought was, wait a minute now, if I got a reverse mortgage to pay off that purchase mortgage, then I don't have to pay any mortgage payments. And then between the 401k and Social Security, I can live nicely. And I do. And that's been going on now for more than a decade, maybe even 15 years. The point being that there's many uses of reverse mortgages. And that one was the paying off of the outstanding amount of the purchase price, actually, or the building price. Because I started with a construction loan, followed by a takeout loan, followed by the reverse mortgage, which paid off the entire balance of the remaining regular forward mortgage amount. And that's the place where I spend most time. That's my principal residence, as it should be. And I come into San Francisco and sit in this little office that you see a picture of. You see me sitting here in my sweater. And the point being that I do own one. I believe in it. And the important thing, this is psychologically important, that I still feel it's my house. Yes, there's a reverse mortgage debt on it. And yes, it will have to be paid off, although there's still plenty of equity because, as Harlan mentioned, values here in the nice parts of the Bay Area have gone up to the point where I probably have more equity in it than I had when I started. But the fact is that, and this is crucial to getting a message across to people when we talk about reverse mortgages, it's still my house. I live in it, I own it. I do whatever I want to it as long as I pay my property tax and my insurance, one payment of which I have to make right after we finish this webinar. But the fact is, many people are afraid of reverse mortgages for psychological reasons. They feel like they don't own the house anymore. And it took me a little while to get used to it, but I did. And as I said, had that reverse mortgage on it for well over a decade. And as time goes on, I keep feeling the house is mine, and I'm planning to even do some planting there and do a bunch of other things to keep it nice. And it doesn't belong to somebody else. It belongs to me. Sure, when I pass on, it will be sold and the proceeds will go to the charities I've named, but it's my house as long as I'm living in it. And that message should be gotten across anytime people are reticent or hesitant or reluctant to think about a reverse mortgage because they think it won't be my house anymore. So that's my experience with it. And it's been a wonderful experience. It's made all the difference because when I retired, which I had always planned to do at 65, and I did, there was no way I could have afforded both that house and the San Francisco home that I use as my office primarily. And I'm still working, as you probably know. So, but although I'm not working in a law firm anymore. So that's my story. I can make it longer or shorter, but that's probably as much as you want to hear right now.
Well, no, that's perfect because without question, there's so many people that have those misconceptions. And I thank you for being transparent and be willing to share your personal story because That's not something that a lot of people will do. And it just makes sense with how it really changed your retirement. Our goal at Fairway is to change the way people do retirement. And, that's a perfect example in what you're talking about. Now, in the information that you were sent to sign on to this webinar, there were 4 things that we're going to talk about. We're not going to talk about them specifically in this order, but we're going to cover all those things. And I'm going to kind of tell you what we'll cover. First of all, the advanced tax planning, our interest, real estate taxes are MIP deductible when things are passed on to heirs or in the beginning. We'll talk about sequence of returns risk and how a client can use a reverse mortgage, maybe also in estate planning and legacy to the heirs. Dr. Sachs has written specific articles on the loss deduction and how this affects children for the better as far as a tax deduction. A little bit about life insurance and how it fits into your planning, because you folks do life insurance, in the Medicaid and long-term care strategies. Now, one thing that we did not have as part of the script, so to speak, but that we were talking while we were in the waiting room before we came on, is interesting. NAIFA has teamed up with Fairway, and Fairway has teamed up with NAIFA because we believe that life insurance and investments and annuities very closely align with each other. And when we were talking before we got on, Dr. Sachs was explaining, in the way he looks at it, is really life insurance, cash value life insurance, and reverse mortgages using home equity when you're older, creating equity while you're alive, as he was paying into his home before he was in retirement, and then after you're in retirement, using that equity to pull it out, is very similar to how life insurance contracts work and affect things from Medicaid to long-term care to your retirement income. Maybe you can elaborate a little bit on that, Dr. Sachs, as to how life insurance and reverse mortgages go hand in hand, which is why NAIFA representatives and Fairway representatives should work together in making a better retirement for our clients.
Sure. As I was saying earlier before we started the formal presentation, initially I was thinking of life insurance and home equity, reverse mortgage. As I started to say, well, they're twins, they're fraternal twins, they're not identical twins. Then I decided, no, that's a lousy way to say it. I think they're siblings. And here's what I mean. They both serve 2 very important financial functions in life. Home equity, or home is both a way of acquiring money, acquiring wealth, because people have to pay their mortgage. And each time they pay the mortgage, the principal portion of it adds to their wealth. And that's an important thing. And of course, the home also shelters people from the outside, from the rain. Life insurance, and also, you have to pay your mortgage. You're at risk of being thrown out in the street if you don't pay your mortgage. Likewise, life insurance, cash value life insurance, is a way of building up some financial wealth. Of course, the term piece of it goes away, just like the interest piece of it goes away, although it's not deductible like the interest piece. But in any event, there is a wealth buildup, and it gets bigger and bigger as time goes on. There's a greater and greater portion of the premiums add to wealth. And also, cash value life insurance, or any life insurance actually, protects the family financially, like the home protects them physically. So these 2 assets serve 2 functions differently. And they serve these functions at different times in different ways. Obviously, the home shelters the family more early on when they need it. There's the whole family. It's generally 2 spouses and 2.1 children. And life insurance protects the family, the dependents of the primary earner, if there's one, or the primary earners, if there are 2, most when they need it, because that's when there's the least other wealth to pay for children's education if the parents, one or both parents, should die. So there's these kinds of things that provide this double function, wealth building and sheltering or protection from outside dangers, whether it's rain or snow, in the case of the house, or the possibility of death of a parent in the case of the life insurance. So that's terrific. And then when we get to later on in life, like retirement time, then both of them can be drawn upon as tax-free sources of income to spend when people no longer are earning money, when they're retired. And I define retirement as the time when you're earning either no money or very little money. I'm retired, so I earn very little money now, but I'm drawing on my 401k assets, which I've rolled over into an IRA, and Social Security is a non-trivial addition to it. And occasionally I take a case. I'm still a licensed lawyer. I'm still certified as a tax specialist. And I have a couple of really narrow little specialties that I think I've kind of cornered the market on. So I get some referrals in that. But the point is that these are terrific wealth building assets. Both of them, they're not twins. They're not even fraternal twins. They're siblings, but they both are very important. And one of the things that can be used in advancing the use of them is recognizing that life insurance in particular should be started early, as well as home ownership. But I think that the importance of life insurance is a little harder to recognize because it's less tangible than a home, but it's powerful in terms of wealth building. And that's my view. And of course, the access of money from either of them, getting into that wealth and using it for needs at a later time, is tax-free. These are monies that can be taken without having to pay any tax on them. Sure, they're loans and they have to be paid back, but not necessarily during the life of the borrower. They can be paid back out of the assets that remain at death. So that it's important to recognize that unlike a regular plain old forward mortgage, which has to be paid every month, or a plain old premium on life insurance, which has to be paid every month also, once you get to the retirement stage and you're drawing money out, these things are, they no longer impose a cash flow obligation. And cash flow is really the essential concern when you get into the retirement years. How's that?
Well, thank you for that. That's critically important. And notice on the bottom of all of these slides, this advertisement does not constitute tax or financial advice. Unlike Dr. Sachs, we are not licensed in law or any kind of that kind of advice. And we give you people like Dr. Sachs that we know when there is issues that need to be covered and partners that you need that are licensed in one thing or another, just like we come to you as financial professionals in the life insurance and asset management arena, because Fairway, even though we have 10,000 employees and 600 offices, we do nothing in the legal or the financial planning or the insurance area. We strictly are mortgage experts and professionals in both the forward and the reverse mortgage side. So what Dr. Sachs is talking about is so critically important in our mind, is that we mesh these two things. Insurance and home equity are both instruments of wealth. The problem is that most people look at insurance as something that pays out when you're dead. They also look at a house as something that's sold when you're dead. And they don't think of how well it can be used. It's called life insurance. It's not called death insurance. And so it's things you can use while you're alive. Of course, you've used that with your clients before. We're trying to explain to our clients, you pay into your house and it's okay to pull money out when you're older. There's just a normal thing. You put money into a 401k, roll over it into an IRA and take money out. That's something that Dr. Sachs planned from the beginning. We also want people to plan, you put money into your house, created home equity, you can pull it back out when you're older. It's just a normal life cycle. And yet so many people don't look at it that way. And the solid research that's been done by Dr. Sachs and our, certainly our good friend, Dr. Wade Pfau, and some of the people at Texas Tech University, Boston College and American College, and all of these different experts, they found that if you do a reverse mortgage early as part of your planning, just like Dr. Sachs did with his reverse mortgage, and you do it at 62 instead of 82 or 92 or not at all, early in retirement, three things will happen. You'll increase cash flow. Well, that's obvious. You don't have a payment anymore. You can decrease income taxes because, as Dr. Sachs already said, all of the money coming out of the proceeds of a house is tax-free. You may pay taxes at closing because there's taxes, transfer taxes and stamped mortgage stamp taxes and that sort of thing. But you can decrease your income tax burden, and that allows you to increase your net worth and legacy. During your life or after your death, whatever your goal is. As Dr. Sachs said, despite the fact that he's got a negative amortizing reverse mortgage, his equity has actually gone up, not down, because of the value of the underlying asset, which he's not losing. He's really not losing his house. He's not losing all of the equity, only part of the equity, so he can afford to have two houses instead of having one with no payment on either one. Many of your clients would like to know more about that. So before I start really drilling down with Dr. Sachs on 4 major destinations, he likes to take road trips. He hasn't taken a lot of road trips since COVID, but every time I've listened to one of his presentations, he likes to take road trips, and he takes people to these different destinations. And so we're going to have 4 destinations today. But before we do, I want to tell you about the road. The road to retirement that we're on is 2 separate areas. When we're building wealth, age 18 to 61, and maybe after 62 when we're retired. Everybody has 3 buckets of wealth. Bucket 1 is your ability to make money, your wages, your commissions, your business income, however you make money. And bucket 2 is the financial planner's bucket. That's 401ks and IRAs and stocks, bonds, mutual funds, mattress money, savings account, general assets under management that you take care of. And then, of course, bucket 3 is the home equity. Now, home equity is regarded as something more valuable than what it is, because when you take cash and make payments, as Dr. Sachs said, every single month, that builds up home equity. You're paying some interest, but you're also paying principal. And now at the end of your work cycle, you have a lot of equity built up, and now you're in retirement. So what do you do when the money in bucket 1 goes down? Of course, as Dr. Sachs said, he makes less money now than he did when he was working full-time for a firm. So when that goes down, where do you get your money? Well, there's bucket 2 and bucket 3. Most people only come to you as a financial advisor and say, give me some money back. I gave you money for a 401k. Now I want it back. They rarely come to us and say, we'd like some of our money back. We gave you a whole bunch over the years. We'd like to have some of it back. And it's odd that people think it's actually a bad idea to give us money, for us to give them money back, because they say, well, then I'm going to lose my house. I'm going to lose interest. That's negative amortization and so on. And it's interesting, as Steve just asked the question, what about people that are just spending too much and then they use up their equity? And what about the fees for the reverse mortgage? We'll cover both of those things. But if people are going to be wasteful in their spending, they're not going to have an IRA in the first place. They're not going to have assets under management to even manage. They're going to be people just like Dr. Sachs that saved money in 2 different places. So the idea is we never advocate foolish spending, but they can use up all the money in their IRA, just like they can use up all their money in their home equity. They have to be careful. It's not something that is mad money that you just throw around. You're careful with it as you would be with any asset. The fees, and isn't that Dr. Sachs, elaborate a little bit on that point?
Well, for what it's worth, and again, this is now my personal story, I drive a 1984 car. And you know what? It gets me there just as fast as a 2016 or 2020 car. And, I wax it. So I keep it looking good. It looks as good as a brand new car. I take care of it. And the registration costs are low. The insurance costs are low. And the fact is, we all have to have a degree of financial discipline. So the answer at least, to the matter of people who spend too much money is they shouldn't. And the society, in a sense, has an obligation to kind of, teach them a little bit of financial discipline. And I don't know how else to say it. I grew up poor, so I knew I had to take care of whatever I had. And I'm happy with what I have. And part of why I am happy with what I have is I got to like what I have and I didn't need a new one of anything. I mean, I'm still, my San Francisco house I bought in 1977. And yeah, I've remodeled it a couple of times, but not massively. And the furniture is what I've had from the outset. I got a new mattress for the bed. I mean, the point is that the psychological notion of accepting the pressure of advertising, and advertising is powerful, but you've got to resist it and dominate that and look at plans, make plans and follow them, think it through. That's what financial advisors are for. And it's hard. I mean, you got to tell people, you may want that shiny new object, but you'll be a lot happier without it because you won't have as much financial pressure. And put money, yeah, it's boring to make a mortgage payment. It's boring to pay an insurance premium year in and year out. But at the end, there's a bucket of gold at the end of that rainbow. So
That's right.
Yes, discipline's important, and I don't know how else to say it. It's a bit boring. It's a bit school marmish. It's a bit standing on a soapbox, but it's right.
Well, it is. And really, one thing I've noticed, there's a lot of financial advisors that will send people to us and they say they're just spending too much. I had one guy that he was spending $100,000 a year, including his Social Security, and they said he's spending too much. Well, as it turned out, because all of it was coming out of the IRA and he was also paying for some health insurance, he wasn't being wasteful. He was just taking too much money out of his IRA too fast. When we did the reverse mortgage, he was able to cut down, instead of pulling $70,000 out of his IRA, he only pulled out $20,000. He was paying over $25,000 in taxes. That's a very significant issue. So we can help with that because we're pulling from another bucket and we can mitigate the taxes, which of course is what we're talking about here today. Now, just a really quick aside, we could spend an hour just talking about this, and we won't because we got to get to the taxes, but I would be remiss in not covering this. Dr. Sachs, many people say, well, compliance says that we can't do this. Let us talk to compliance. Dr. Sachs will even get on the phone with your compliance people. We'll pay him to do that because he got FINRA to change their stance. He called some folks at FINRA. He explained that, hey, the research, this is not a loan of last resort. They have an investor alert that says avoiding a reversal of fortune. And he said, that's not right. This is something that is safe. And it's something that when used correctly, actually can increase people's net worth. You shouldn't say that it's a loan of last resort. And sure enough, several years ago, they changed that. And so when it comes to anything to do with compliance issues of whether or not a reverse mortgage can be talked about, please get in touch with us because we've dealt with that. And we've had Dr. Sachs, Dr. Pfau, Jamie Hopkins, a number of people work with compliance departments to explain how this can be properly used in planning. And if I were you, Dr. Sachs, I know you accomplished a whole ton of things, but you should be very proud of this because nobody else did it and you did it.
Well, thank you. And of course, you remember the story I told before about calling up FINRA and spoke to somebody. And I said, hey, look, I've got your investor alert here. And I've done some research. I published it in the Journal of Financial Planning. And so did some other people independently. And we both pointed out that it shouldn't be a loan of last resort because you come out better if you integrate it, if you coordinate the reverse mortgage credit line with your securities portfolio. And of course, all FINRA is worried about is the securities portfolio. And anyway, so they said, well, send me the research. I sent both articles, mine and John Salter's article from Texas Tech. And they, just as Harlan's saying, they took out that very sentence. And later people asked me, well, who'd you talk to? I said, I don't know, I think it was the janitor.
As long as it got to the right person, we don't care who you talk to.
It came out, as long as the article, the offending sentence came out.
Exactly.
So.
And if you want to read more about that, this is the article. If anybody wants these articles, simply send an email to reverseevents@fairwaymc.com, and we will be happy to get this information out. I'll put it up at the end of the screen too, or you can email them right now, reverseevents@fairwaymc.com, and we will get you a copy of those articles, the investor alert, and the slide deck here, anything that you would be interested in. Now, the first thing that we have to talk about before we set out on the 4 destinations, and we're just about at the right time spot here, is acquisition debt. There was a big change in 2017 that the only thing that is deductible is acquisition debt. Can you elaborate a little bit on what that change means, Dr. Sachs, as
Sure.
far as how that changes the way that people plan?
Right. What's deductible? It used to be that any interest on any loan secured by real estate was deductible when paid. What they changed was that only interest on acquisition indebtedness, that interest can be deducted whenever it's paid, not before it's paid. And acquisition indebtedness is indebtedness incurred for the purpose and actually used for the purpose of building, improving, or substantially remodeling, like building, buying, or improving property, which is a primary or secondary residence. So the home mortgage is the perfect example. A home mortgage, which is a purchase money mortgage, the one you get to buy the house. And anything that refinances such a debt is also acquisition indebtedness. But what's not acquisition indebtedness is the classic HELOC, which you take for purposes other than building, improving, or purchasing property. So the HELOC interest is no longer deductible. So that's the distinction. Now, when there's a hybrid situation, imagine that your house was bought for, I don't know, pick a number, let's say $300,000, and you owe $200,000 on it. And then you go and it's gone up in value to $700,000, and you go get a refi that, I'll pick a number, it's $500,000 of loan. Now, of the $500,000, $200,000 is refinancing that original purchase debt, but the other $300,000 is not. So the interest will be deductible only on 2/5 of that debt as you're paying that down. If it's a loan that's a refinance, if it's a reverse mortgage, the same issue comes in. Let's imagine that, we'll take the simplest case. You bought a house for $300,000, and you get a HECM for purchase, a reverse mortgage that helps you purchase that house. And let's say, for example, the $100,000 of the $300,000 purchase price is a reverse mortgage. Then the interest, whenever it's paid, will be deductible. But now let's go to the hybrid case. You decided you bought a house for $300,000, and you have a regular mortgage of $100,000 on it, and you decide to fix it up. So you get a reverse mortgage for another $100,000, or let's say $200,000. One pays off the old one, and the remaining $100,000 of the $200,000 goes to pay for the improvement. Then the interest on that will be deductible. So it's really looking at how the money is used. The purpose is a little bit vague, because you tell the wrong story and don't use it for the stated purpose, then you're going to get in trouble. But if you actually use it, and you have to be careful of these things, you want to keep good records of the money spent for either buying or improving or building a home. So that's what acquisition indebtedness is. And the other term, the one that's not deductible, it's called home equity indebtedness. And that's a little bit misleading in that it would appear to include acquisition indebtedness, but it doesn't. The term technically in the Internal Revenue Code, section 163, if you want to know, defines it as anything but any debt secured by home equity that is not acquisition indebtedness.
Thanks for that. Actually, there's a ton of people that are professionals, even in our business, that don't understand that, even though we're in the mortgage business, and we try our best to educate people because there was a major change on that in the 2017 tax law. They can't ask the question, what if you pay cash and refi 6 months later? That is a little bit of a gray area, but from what I understand, what I've learned from Dr. Sachs is it's 90 days. Or the same year. I've heard different things from different
Yeah.
tax folks, but it's got to be pretty quick.
Mhm.
One of the questions that were asked is, what about the expense of a reverse mortgage? First of all, it comes out of your equity. You don't have to write a check for it because it is subtracted from your equity. So if you're eligible for $300,000 and the costs are $10,000, well, then you only get $290,000. But what we're going to talk about is our road trip destination. And we're going to go to road trip destination number 1, as Dr. Sachs likes to do in following the road through. And that is something that he wrote, which is somewhat outdated because of the tax law changes, but the premise and the thought process is still correct. And it's called the loss deduction because most people lose it. I haven't talked to any financial advisors that knew about this loss deduction unless they had been to one of Dr. Sachs's seminars or talks. And this is where the deduction of the acquisition indebtedness that is not used during the client's lifetime can actually be used for the deduction. And we can send you this article as well. Remember, it's somewhat outdated because it's 2016 before the 2017 tax law changed. But this is something that is very important to understand, that some or all of the accrued interest can be deductible for the children. We always think that the kids get hurt. The kids can be better off at the end if they understand this. Now, for example, there was a question that before I asked Dr. Sachs to explain his article, there was a question that was asked, can you provide light on the taxation when a child inherits a $300,000 home that was purchased by his mom for $100,000? And next, would the child pay less in taxes if the home had a reverse mortgage lien? Dr. Sachs is going to explain the second part of your question right now. But the first part is, right now, we're going to go to destination number 4, which is the future. And we could lose a step up in basis.
Yeah.
Right now, there's a step up in basis, and he doesn't have to worry about that. Child doesn't have to worry about taxation if he inherits the home. But let's start first at destination number 1. Tell us about how the children can get a massive tax deduction at the end of after their parents pass away.
Okay, so let's start with how the deduction can be lost and then how it can be recovered. Think of the situation where the parents have perhaps bought a house late in life, so the indebtedness is acquisition indebtedness, and they do what I did, which is they had a reverse mortgage replace that acquisition indebtedness. So it also, any refinancing of acquisition indebtedness is itself acquisition indebtedness to the extent of the amount that's truly acquisition indebtedness. Remember the hybrid situation where the house jumped up and they got more money out than was the amount of the preceding debt. So take the simple case. The parents bought the house relatively late in life. Maybe it was their retirement home. And they had a mortgage, which they used to buy the house. And then they decided that it was too much of a drain on their cash flow. So they said, let's get a reverse mortgage. And they did. And now they have no more mortgage payments and a reasonable accrual of interest over time. And then they die. And the house is taken by the estate. And the estate sells the house. It pays off the reverse mortgage, including the interest part, and gives the net results, net proceeds to the children. Well, the estate paid the interest because it paid off the whole debt. But typically, with relatively few exceptions, estates don't have enough income to have a significant income tax, and therefore don't have enough income to offset that interest deduction. So it's lost. That's the loss deduction. That's why it's called the loss deduction. How do you recover the loss deduction? Well, it's too late if the house has been sold by the estate, but it's not too late if the house subject to the debt is passed on to the children and they sell the house because they get the house subject to the debt, they then effectively owe the money. And when they sell the house, because that's part of the deal, unless they refinance it themselves, which is a separate issue and unlikely. Most children, by the time their parents die, either live far away or have their own homes or whatever. So they're not interested really in taking back the parents' house. They simply want to sell it and use the money maybe for their own kids' education. Whatever it is, the fact is that if they sell the house and pay off the reverse mortgage accrued debt and the whole debt, including the accrued interest, then they get the deduction. So that's how the deduction would be recovered. And this is actually dealt with both in the article that in the Journal of Taxation, the 2016 Journal of Taxation. I think it's April, that's the month, tax month. And that's because there's a regulation that's very specific. And I believe it's section 691B, but it's been a little while since I've looked at it. But it's cited in the article. So if you get a hold of the article, either by putting into your computer the website that's HTTPS Tools for Retirement Planning, or just get it directly from Harlan, you'll find a specific citation with a specific language. And this is called a deduction in respect of a decedent. It means the person who has gotten the asset subject to the debt and would get a deduction because they got it from the decedent, the deceased parents, they get the deduction. So that's how it can be recovered. Now, this becomes a question for a probate lawyer rather than a simple barefoot country tax lawyer like me, to know whether the executor of the estate can make the decision to pass the house on to the children or not, depending on how the will is written. And this may be a matter of state law. It may be a matter of sort of well-established protocol in the probate law world. It's not a world that I deal in. I just call up my friends who are probate lawyers and ask them. So the point is simply that the method is to get the house subject to the debt to the children who can benefit from the deduction, rather than the estate itself selling the house in most cases, because the estate rarely has enough income of its own to offset or to be offset by that interest deduction.
And John, the question that you asked, could a trust liquidate the home, or does the home need to transfer on death to individuals? If the trust has a tax liability, you could use the trust, but it does have to be just like the estate. The estate can't sell it, the trust can't sell it, the individual needs to sell it. Did I say that correctly in answering that question, Dr.?
If the trust itself has income that's sizable enough to be worth offsetting against the interest, which is likely to be fairly large, then sure, it may as well sell it. But if it doesn't have enough taxable income, then it's better to pass the house subject to the debt to the people who can benefit from that interest deduction. And again, it has to be looked at to be sure that it's acquisition indebtedness interest rather than just plain garden variety of home equity interest.
So if you leave an IRA for your child, which of course there's only 10 years now, and then it's gone, that is something that can be a huge issue. I've had some financial advisors that told clients about this, that thought that a reverse mortgage was bad. It saved them tens of thousands of dollars in the asset transfer of the IRA. This is something that will make you very valuable to know this, because the number of financial advisors that know this is a whole lot less than a couple percent. And now you guys know it that are on this call. So you can thank Fairway and Dr. Sachs for bringing that information to you, because very few people understand that, because they don't know what happens at the end. Somebody asked, when a person has a reverse mortgage and dies, does the family have an opportunity to pay off the reverse mortgage and keep the house, or they have to pay market price? And as you heard, no, the house is sold. You don't have to pay market price. So if the house is worth $800,000 and you sell the house for $800,000 and $300,000 is owed, The other 500,000 goes to the children. And as long as we have the step up in basis with no taxation, and they could also get an additional deduction in road trip destination number 1 that Dr. Sachs just explained. Now let's talk a little bit about number 2. And that is that we can have tax-free distributions from the home equity. Now, we could probably spend an hour, and we only have 15 minutes left, but there is a very, many of our financial advisors are delaying retirement income with deferred annuities or early forced retirement. They are providing funds doing Roth conversions with the IRA. What are a couple of things as we talk about kind of the Swiss Army knife of the way that you've seen people use this for a tax-free distribution after they paid the tax at closing?
Well, I think to me, the most important thing to remember in any of all the things is don't let the tax tail wag the financial dog. Think what's important for the individual's own economic, financial situation. And then if there are approaches that otherwise are equal, then let the tax issues come into play. But really, people shouldn't be doing stuff just because they'll get a tax deduction, even if it ends up costing more money, or if they get a tax deduction now and it's going to cost them more money later. There's all kinds of reasons that people will think tax first, and they shouldn't. They should think overall economic situation. That's what a good financial advisor is there to help people think about. Okay, so now let's talk about some tax aspects where things are more or less equal or even more favorable. And here's the one that I like, because I invented the idea. Remember that when you're drawing from a thing like a 401k or any securities portfolio, there's volatility. And when the volatility swing is at a downward part of its cycle, then it's better to draw money from a reverse mortgage credit line, or for that matter, from an insurance cash value. And the reason for that is that you've got to let the portfolio, the securities, which are inherently volatile, swing back up. And you know that sooner or later, at least if history is any guide, that it'll go back up. It may not be this month or this year, but it'll go back up. At least historically, we've had it that way. Now, there have been periods with a few years of decline, but there's never been periods of decline year after year after year, or nobody would invest in securities. So people do, and you have to, because in the long run, it averages out to they're having a better rate of return in the long run than any other kind of investment that is liquid enough to live on. So now, when it's down, you could draw from the portfolio. You have to live. The retiree has to live. But drawing from a reverse mortgage credit line or drawing from an insurance policy loan, these are tax-free. So the overall expenditure will be less. So there's a double benefit in this. One is it lets the portfolio recover more readily. There's more in the portfolio, so you don't draw from it. There's more to recover. And the overall expenses, which include income tax, is less because they've taken less. Now, of course, we all have to take our minimum required distribution once we get to a certain age, which has now gone up a little bit. But the point is that if you have to take a required minimum distribution at a time when the portfolio has gone down, you have no choice but to do that because that's the law. But at least take only the minimum and then reinvest it, because the idea is the portfolio in the aggregate is going to go up. And I call it the mirror portfolio, just for simple calculations. The mirror portfolio is on the non-tax sheltered side of the barrier. But at least in that context, you haven't taken probably as much as you might otherwise take to live on. Therefore, the amount taken is less, and therefore the amount of income tax is less. So there is a small tax benefit to this whole algorithm of drawing from the portfolio when it's gone up and drawing from the loan source, whether it's a reverse mortgage credit line or a cash value life insurance policy, when the portfolio itself, the securities, have swung down, have gone down in their volatility cycle. And it's very interesting to think about how powerful that effect is. I just literally this week submitted an article to the Journal of Financial Planning, which points this out. In the key phrase, it's just 3 words. This is an article with 6,400 words, but the key words are volatility is risk. And the idea is you can diminish the risk of running out of money entirely by recognizing the volatility and not drawing from the portfolio when it's had a downswing in its volatility cycle. And that's the article that I published in 2012. It's the same notion that Salter and Avensky and company published the same year, although later in the year. And the more I think about it, the more I understand it. I mean, I wrote this stuff in 2011 and 2012, and I've learned more about it just in the last 6 months, having written this new article. And the point being that, yes, there's a tax benefit, absolutely, but that's not the central point. The central point is the financial benefit. And here's the example. I know we're getting close to the end, but this example is worth thinking about. You got a portfolio worth $100, or as many more zeros at the end as you want. And it suffers a decline, a downswing in its volatility cycle, and it's down to $80. Now, if you don't take anything from it, then it takes a 25% increase to get back to the $100. But if you take $5 from it, you're down to $75, or again, as many zeros as you want at the end. And that takes a 33% increase to get back to the $100. The lesson is, if you draw from a portfolio when it's down, you make it harder to recover. And over a 30-year retirement, all that has to do is happen a few times, and you're going to run out of money. Whereas if those few times when the portfolio is down, by few, I looked at the S&P 500, and I actually included that in the article, and there were 21 up years and 9 down years between 1990 and 2019. So there's more up years than down years, and that's true. And those are the years, the down years, when you should draw the year following. Of course, you can't draw from your reverse mortgage during the down year because you don't know how it's going to end. It's always the year following the one where it's had a downturn. Anyway, that's, again, what I'm illustrating here is that, yes, the tax is somewhat of a benefit. You probably have to draw less than you would normally draw, or distribute, or whatever word we want to use, because of the tax benefit. But the financial issue is more important.
Well, thank you for that, Dr. Sachs. And we're down to the last 7 minutes, and we got a couple of destinations. And by the way, if you have any questions that you need any of the information here, the slide deck, which goes into more detail, we're covering a lot of ground in a short period of time. But please contact the Fairway loan officer who invited you to this webinar, or send us an email at reverseevents@fairwaymc.com. And also, if you want to be invited, NAIFA has some folks that are going to be on our May 19th summit that we have from 9 to 5 that will include Dr. Wade Pfau, and the Retirement Income Summit. If you would like some information on that, just check your NAIFA board or ask us for an invite. It is free if we give you an invite. Now, realize all of these costs revolve around 2% mortgage insurance. People say, how much does the reverse mortgage cost? The same as any other mortgage, except there's a 2% fee that goes to FHA. So that is always something that's available. Now, somebody said, can I take money out whenever I want? Yes, you can. You can take a lot of money out, or you can take a little bit of money out. It just depends on how you want to do it with a line of credit. So you can take a lump sum out, like Dr. Sachs did, to pay off an existing mortgage, or you can take out a monthly check, like an annuity, or you can set up a line of credit and only pull money out or put money back in as you need it to regulate how much equity is in your house. Now, I won't spend much time on this because I want to hear the rest of the time from Dr. Sachs. But I spent some time thinking after the 2017 tax law about stacking deductions when deductions went to 26,000 for a person over 65. Well, most people lost their deduction on their acquisition indebtedness. And so I kind of wrote this up, and we sat together on a napkin at a seminar in Arizona shortly after this happened with Dr. Sachs. And I wrote a little paper, which he corrected some things and edited. And it's a chapter in my next book that will come out, and you're welcome to have this. But basically, if you build up the amount of interest and you make a payment, it's very similar to the kids taking a tax deduction, but you just let it build up during your lifetime and pay it down whenever you want to, whenever your deductible interest is above the $26,000 itemization limit. And then you can deduct 50,000, 80,000, 100,000 because it's acquisition indebtedness that occurred. There's some asterisks with this, and it's a couple of pages of writing, and we don't have time to go over it now, but simply let me know, and we'll make sure that we get that sent out to you. Now, I want to make sure that we hit the future, and so we won't spend a lot of time on silver divorce, but there's a lot of, Dr. Sachs and I have both talked about this. There's a lot of taxation issues that revolve around this, but I want to get to the future. And so as you have questions with any of your clients who are over 60 and they went on silver singles and got a new husband or a new wife, you need to make sure that you help them through the process, because it's a big minefield with a lot of potential taxes involved. Don't be afraid to talk to us. So I want to go to road destination number 5. There's some future stop signs or bridges out. What is your feeling, Dr. Sachs, about, are we going to lose a step up in basis? The capital gains tax, how is that going to affect things, and how does that go in? And are you advising Bill and Melinda Gates? Steve was wondering about silver divorce. So let's look into the future in the last few minutes that we have together.
Okay, well, if I had to guess, I would guess that the step up in basis will not be gone, simply because, why am I saying it? For 2 reasons. One is, it's a pain in the neck. A lot of people don't have enough records to even know what their basis was. And I think that there's going to be a lot of clamor from people about that. And second, although of course they're going to be dead, so they're not going to be clamoring when they're dead, but they may be clamoring in advance for their heirs. And the other reason is, I think it was tried once before, much earlier in my career. I think in the 1980s. I've been practicing since 1973. And I think somewhere in the 80s, they tried to get rid of the step up in basis, and it was a disaster. So just why, I don't know, but they abandoned it. Capital gains tax, I do believe will increase, and I think they should. And I believe also that the limit, the $11 million limit before estate tax sets in, I think is obscene. I mean, I'm speaking now, you're seeing my left-wing, Northern California, bleeding heart liberal tendencies. But I think that nobody should get $11 million just because they happen to have rich parents. I just think that's wrong, and it should come down. This notion of, well, it was already taxed once when it came in as income, I think is nonsense, because when you go to the grocery store, you're buying your beans with after-tax income, and the grocer has to pay income tax on that money when he makes a profit on a can of beans. So that argument is fallacious. So that's my 3 comments there. I also,
go ahead.
Let me just make one quick comment about the silver divorce. Think about this. Imagine a spouse, a couple is divorcing, a spouse wants to stay in the house and has to take out money from the IRA or the 401k in order to buy out the other spouse's interest. That causes a big tax hit. On the other hand, if they get a reverse mortgage, they can buy out the interest of the other spouse with no tax consequences, whatever, to either spouse, because there's a special provision in the tax code that says that interspousal transactions have no capital gains tax consequence. They take the old basis with them, but the fact is that that there is no tax on that transaction because of a special provision, special exemption in the Internal Revenue Code for interspousal transactions, even in the context of divorce. So that's a good thing. And so obviously the way to go is to get a reverse mortgage. That's the clearest example where the economic results are the same, but the tax results are dramatically different. And therefore the reverse mortgage is clearly the smarter way to go. We're talking about sizable amounts of money because typically homes have appreciated. And I think it's crucial. So that's that. I just didn't want to let that destination go by unrecognized or uncommented on.
Well, thank you for that, Dr. Sachs. And if anybody on this call wants more information, wants to find out more, contact us. We happen to know where Dr. Sachs lives, and we happen to have his phone number. And so we can get some more of his wisdom. And if you hire him, he's going to charge you something, but we can get some free information that we get Fairway, and we'll make sure there's some help. Thank you, Dr. Sachs. Could not appreciate your wisdom more. We appreciate your time.
Opportunity. Thanks. It's always a pleasure. And this is an interesting way of doing it. We haven't done it this way before with the interchange. And I like it. It was fun.
Good to hear. Thank you.
Well, thank you both for joining us today. We really appreciate that and really appreciate the partnership that we have with Fairway. For those of you, this will be available on demand in NAIFA's Business Performance Center. So we'll be following up with an email. Please visit bpc.naifa.org and you can access this recording. So thank you very much.
Thank you. It's been a pleasure.
Thank you, Dr. Sachs.
Thank you all for the opportunity. I enjoyed it.
We sure did too.
Goodbye.
Bye-bye.
Bye now.